Hey folks, Dan Free here, the rate update. Today is March 9th, 2021, and I think we finally got a breather. So I'm going to go over some of the numbers next, but you'll like the news, so don't go away. We'll be right back. Okay, so what happened in the markets today? Basically, we focus on the mortgage-backed securities market because that's the biggest component that controls mortgage rates. They just got decimated in the last 2-3 weeks, and there was an overreaction in the market. So here's the backdrop of everything. The government came up with the stimulus package. They've been talking about it, and then all of a sudden it was like, whoa, this stuff's going to come true. So that caused the 10-year Treasury to spike, and then everybody's starting to freak out about inflation and all this other stuff. So you started to see the stock market just plummet, mortgage rates go up, and everything. Well, now, I guess I'll say cooler heads have prevailed. The government, the Federal Reserve, all parts of the government, even people in the stock sphere, economists and everything are coming out saying, yeah, there's going to be inflation, but let's not just jump into it yet, guys, and think it's going to basically just run out of control. In the short term, we'll probably hit some areas, but 2022, 2023, things are looking a little dismal. I think otherwise. So you're going to see a lot of economists and people coming out saying, there might be a recession next year or the following year. I don't think so. I think we're going to have a V-shaped recovery, but only time will tell. So my thought is, lock in when you can. Here's what I'll say. And a lot of people say, "Oh, you fear monger. You're telling people, one day the rates are going up." Let me give it to you this way. If you bought a stock, you want to buy it when the timing's right. You're never going to catch an ultimate bottom. And you're never going to, get out on the complete top when you're talking stocks. Nor in the mortgage business, I very rarely see us, even me, hit the absolute bottom. We don't know. We don't have a crystal ball. And mortgage rates trade all day long, so they change and change and change. I monitor on your behalf. What I normally tell most clients is, let's say, okay, you're comfortable at 2.99. I know you wish you had 2.5, but I can't get you 2.5. But let's do this. Can we compromise at 2.99? If I get that in or better, are you good with things? You then tell me yes or no, and then I put the ball in my lap. I will promise you that I'll get you that rate that I guarantee you, and if it goes any worse than that, I drop the ball, I'll eat it. I'll pay the points or whatever needed to be to get you that rate that we agree upon. So that I'll put that backdrop in all of this. So let's get on to what's happening in the market today. Okay, so we go first to headlines. There's a Treasury auction tomorrow, and that sets the tone on a lot of the appetite on if investors are buying bonds and what kind of bonds are they buying. The 10-year Treasury, mortgage-backed securities, what are they buying? What's the appetite? The more they buy, driving up the price. What do we say about price? We love when the price goes up. Why? Prices of the bonds go up. That's what we follow here. This is what's happening to the price of the bond. As it goes up, mortgage rates come down. That's its simplest form. If you check out the chart from here to here, we hate that chart, and it is a catastrophic move. Let's go back in time and let me just show you, how big of a move this is. Back a year ago, when the world basically ended, look, this was that spike. And again, when this goes down, rates are going up. So let's bring it across here. Okay, so this is where we were a year ago before the pandemic hit. Well, basically, I'll say here. Okay, so that's where we were. And then everything kind of went crazy. Then we recovered, and then the Federal Reserve stepped in, and they said we're going to make rates as cheap as we ever could in history, and we're going to keep that position. And that they left things right there. Okay. So that's what happened. Now we start to see the pandemic or the virus starting to subside because of the vaccines. We now have all this stimulus package coming into the markets. That's helping ease everything. So we aren't in devastating times. This is when it happened, the event, and this is where we're at the tail end of it. So we're going to get back to normal rates. I think we should still be trading a little bit higher in price, meaning down in rate. So let me get back to that. So where I think we should be trading is around this range, okay? And or maybe this range. And I'll leave it right there. So there and there. Okay, why? That's the long-term trend, because we overreacted here, and then we came back, and then we overreacted again. And a lot of these events, the GameStop thing hit, Bitcoin was going crazy, the inauguration came into play, and they thought there was going to be protesting and all that other stuff. All this is going through this. Then inflation hit, and the 10-year Treasury spiked, and all that other stuff. Things are starting to subside. Now, people are analyzing this, watching it, saying, okay, we're getting back to a little bit normalcy. We're not going to have the lowest rates we ever had in history because we've never had a pandemic like this in history. So now we're getting back to normal rates. So we should ease up a little bit in rates and start to stabilize. Okay, that's what I see. Later in the year, coming fall, winter of this year, we're probably going to see inflation spike up to 2.5%. That's where the Federal Reserve they're saying they won't, but they will start to focus on things saying, we got to start monitoring things. However, on the flip side of that, their mandate is two things. They are to keep inflation in check and employment at its maximum or its peak. So, when the stimulus package goes into effect, it's going to pay people all the way through September for unemployment. So are we going to have a huge employment recovery prior to September? I say no. Why? Because if I'm going to make $1,000 a week sitting at home instead of going to work and making $500 a week, what would I elect to do for me and my family? You make your decision. You fill in the blank there. So I'm not looking at employment numbers to really, really, really get back on track until after September, when they say, okay, enough is enough on this front. So that's what I'm looking at there. So I don't really think anything's going to majorly happen until September. Yeah, we're going to have some volatility in rates, but we shouldn't have catastrophic events like this, nor like what we saw a year ago down in, okay, come on, chart, work with me here. Oh, I hit year to date. My bad. Let's go back to that. For the year, we're not going to see this unless we hit pandemic number 3 or however that goes. So that's basically giving you an explanation of what's going on here. We're just starting to see some things stabilize. I like this number. I want this number, the 10-year Treasury, to be at 1.4 or less. And there's reasons behind that. Basically, the S&P dividend yield. And I have other videos explaining that. So I won't go into that detail right now. What happened throughout the day? Well, we saw the market up 23, but that's the end of the day. What actually happened? Like when you watch a stocks usually bounce all day long, and then it ends up where it ends up. But you're like, man, how did it get there? Well, we opened up the day. We opened up here, but we opened up here. We were up, I think it was 25 or 30 for the day. That was fantastic. Then we started seeing people get out of the market. Come on, stay there. And they start selling and selling and selling. That's what you see a lot of these reds. People were selling, more people were selling than buying. Then we hit bottom. And then it's like, oh, okay, now it's a good entry point for a lot of investors. They start buying up, stabilized, sold off, buying up. And the nice thing is we ended on a green candlestick. That means there's more buyers than sellers at the end of the day. That is going to bring upward pressure to prices tomorrow morning at the opening, which again, as the price goes up, rates go down. So I like the ending of the day, the green candlestick. Not a big buy position, but big enough. These are huge positions, buy positions that are stepping in, okay? But at the end of the day, we had all these candlesticks, green, 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 green. So we went all the way into the day from about 2:30 through the end of the day with more buyers than we had sellers. Great way to end the day. Market wrap, the Dow Jones ended up 30, S&P ended up 54. It was up much bigger than that during the day. There was really no news out today. Tomorrow we're going to have the biggest event coming out is the Treasury auction is going to be coming out tomorrow. And we'll find out how, what the appetite is for treasuries. A lot of this other stuff, if you read a lot of analyst reports, they're expecting or good chances of a recession in 2022, 2023. I don't think so. That's my feedback. So read as much data as you can to get kind of a gauge on the market that you think. Economic calendar for today was basically nothing. Tomorrow's when we start getting the interesting components to come in. We have a lot of these indexes. Consumer Price Index, X food and goods, and so forth. This is going to give us a read on where inflation is. And if it's up down, or whatever. Let's look at a lot of components. Food up, energy up, construction costs such as lumber up. So this number could come in hot. But because of those things, are we going to see a quick and a rapid deterioration of this market? I don't think, because I think a lot of these numbers are built into the pudding at this point. The piece of the puzzle that everybody asks me to do every day is, Dan, what are the average rates out there right now? So guys, these aren't my rates. These are posted every day that I get alerts saying throughout the whole country, this is the average. Now, your rate could be a little bit higher than this or could be a little bit lower than this based on how your criteria of your loan. There's components that go into your loan that a lot of people don't get. And those components, the biggest elements is what your credit score is. If your credit score is low, this rate's going to be higher, okay? If you're we call your loan to value, it's your loan amount divided by your home's value. If it's really high, this number could be a little bit higher. Okay, if you're looking to cash out instead of refinancing your just primary loan, this number can be higher. So there's a lot of factors that get involved in this. And again, this is the average out there. You're going to have some that are lower and some that are higher. So keep that thought. So now we go through the 30-year terms that I have: conventional, jumbo, FHA, and VA. Today it's 3.21, 319, 326, and 285. There's basically not any moves in the market other than VA. VA took a little uptick. So 1 day delta means 1 day change, 7 day change, 4 week change. So this number right here represents, so I'll go over here, this is easier to see. 6/100th is what that means. So 0.06. This is 10th. 0.10. 9/100ths. 0.09. So that means if the change is up, we're up 6 basis points from where we were. This would have been 3.15 7 days ago, but now it's up to 3.21 because we picked up 0.06. Hope you get it. Just simple math. This is where the changes come in place. Look, we're up all about 0.3, so 3/8 of a percentage point were up in the last month. That's a quick, fast, big move. You usually see this over a 6-month year time frame, not a couple weeks. Okay, so that's what basically spooked the market. So there's where rates are today. This newsletter will be going out shortly, basically telling you mortgage rates are modestly lower, but we're hoping to get more. And the 10-year auction is coming out tomorrow on Wednesday, and we're going to see how that goes, because that will determine the future direction of the rates and the market. So my name is Dan Frio. Like I said at the beginning, I do the rate update every day, and I do the morning market update every morning around 9-10 o'clock a.m. to give you guys what's going on with stocks, real estate, crypto, and bonds. Please check that out. Hope you like it. But this version is me talking about mortgages. That's what I do for a living. I'm a mortgage lender. Have been doing it for 33 years. All I ask you to do is a couple things. I hope you're getting value from the channel. If you are, please give me a thumbs up. Subscribe down below. Hit the bell so every time I post a video, you get an alert. But you're like, guys, or Dan, I like what you're saying. I like what you're tracking. What can you do for me? So here's what I ask you to do. You're out there and you need a mortgage. You're building, buying, refinancing your mortgage. You might get a quote. You might not have a quote. Here's what I ask you: if you're doing any of these things, you need help. You need a consultation. Because why? Well, you want to know, here's my credit score, here's my criteria. What program do I fit into? Or what programs do I fit into? Why? And what's my best option? Well, if you normally call anybody, they're just going to say, oh, you fit into a conventional loan, that's where we're going. And then they're going to stick you into that, and you don't know why. We want to educate you on why, what, where, and how. So we say, okay, conventional is the program to go, and here's why. Here's the rates, here's the cost. And almost probably, I'll say at this point, 80% of the time we're beating the other investors or other lenders in cost and fees. So if you have a quote out there, we as a lender have to send you what's called a loan estimate within 3 business days of pulling your credit. Shoot me a copy of that loan estimate. Let me review it, and I'll go over it with a red pen, and I get back with you real quick saying, okay, here's them, here's me. And then I'll put on the side, I win or they win. Hopefully I win, and then I say, okay, what do we need to do to get you started? But what I normally do is I reply back to you and say, okay, here's what I can do. Here's what they're doing for you. And you pick the winners or losers, and there's no high pressure sales. Just saying, okay, here's what I can do for you. If you'd like my assistance, please let me know. Get back with me as soon as you can, because rates change a lot, so we can lock you in and proceed. So the best way to do this is this. go to therateupdate.com. Guys, don't go to preferredrate.com. That's the company I work for. Go to therateupdate.com. It's going to take you to this website. I created this website. We have a mobile app. This thing is fantastic. Click it, and it'll route you to the mobile app. You can follow your loan all the way from application, credit pull, underwriting, appraisal, and closing. Awesome system. We are integrating our website to it as we're speaking, but right now the app is the only piece of the puzzle that's integrated. So if you want to get started, click that. If you want to apply right now, just click apply here. If you're like, I don't really want to know, Dan, you said, I'm looking to buy a house, but I don't know what program I fit into. Well, awesome. Hit the home purchase qualifier. This will ask you about 12 to 18 questions. It'll help you and help me determine what's the best program for you. The best program for you, not me, you, okay? This is the same kind of criteria or walkthrough, but this is for refinances. Okay, it's going to basically, are you in an FHA loan now? Well, maybe the FHA Streamline's the way to go. So it'll help pinpoint to both of us the direction we should be taking. If you want a call or correspondence with us back and forth via email, click this button right here. It's basically saying, hey, I need some help. Can somebody reach out and help me? Okay, if you want to give us a call, here's our 800 number. It's 844-775-LOAN. It's 844-775-5626. Or like I was just saying before, if you get a loan estimate and you're like, Dan, can you take a look at this and see what you guys can do? Email that or email me your mortgage statement, whatever you do have that I can review and get back with you. My email is really simple. My name is Dan Frio. My email is dfrio@preferredrate.com. It's as simple as that. So that's it for today, guys. God bless. Take care. Keep warm. Be safe. And I'll see you tomorrow. Bye-bye.